we're going to be looking at accounting for stock options. In our example, this company on January 1st, 2011, awards stock options that allow executives to purchase 12 million shares of the company's common stock. Uh, they have to do this within the next 6 years, but they cannot exercise these options before December 31st, 2013, which is called the vesting date. The amount that the employees have to pay is equal to the current market price. The price they have to pay is called the exercise price. As an incentive, companies normally set the exercise price either at or above the market price on the date of the grant. On January 1st, 2011, the market price is $17 per share. But that does not necessarily mean that the option is worth $17 a share. The option contains certain risk. The risk that the market price of the company's stock will not rise above $17 per share. An option is worthless if its strike price or its exercise price is greater than the market price. No one wants to pay $17 for a stock that can be bought on an open market for $15. So to determine the fair value of the option, a model is utilized to determine the fair value on the date that the option is granted. And this model returned a fair value of $5 per option. Since there is a gap between the grant date and the vesting date, most awards call for the award to be forfeited if an employee leaves before the vesting date. Now, stock options will impact income taxes. We're not going to be really covering that, so we're going to ignore income tax, and we're going to determine the total compensation costs over the life of the vesting period from January 1, 2011 to December 31st, 2013, and how much of this cost will it recognize each year as a compensation expense. The first thing to understand is that the accounting will be done during the vesting period. The fact that the employees have 3 years after the vesting date to exercise this option does not enter into the accounting. Right, so we have 12 million shares to buy 12 million options to buy 12 million shares. We have $1 par value. The current market price is $17, and the model gives us a fair value of 5. So let's determine the total compensation costs. Well, again, we have 12 million shares. Next, we need to determine the fair value per option. And that is going to be either the par value, the market, or the fair value based on our model. And GAAP uses the value that is generated by the pricing model. So it's going to be $5 per share. So the fair value of the compensation, to answer the first question, is going to be the number of options times the price per option, or the value per option, and that's $60 million. The compensation expense will be spread over the 3-year period, so each year we'll take $20 million, and over the life of the options, over this 3-year period, the vesting period, will recognize compensation expense which goes on the income statement each year of $20 million.